Talk about the drill baby drill thing. So yes, I would 100% agree that that this industry responds to price and returns rather than promises from government. And different types of companies have different ways of doing it. But for example, a typical play that private equity would run would be uh, they come out to budgeting time at the end of the year. They look at prices. They decide what the optimal amount of new drilling would be based on the price environment. They commit the capital. It has to clear a certain rate of return. They hedge it aggressively, and then they've essentially locked in the cash flow for their investors. Okay, so that's how that would work. And then I think on the public side, probably a little bit more nimble, but the same type of approach. And so if that's true, then what can the government do? Well, the government can do exactly what you said, is they can reduce the tax burden. They could reduce the regulations around transportation. They can't do a whole lot about price itself, but like you mentioned, IDC. So if you can increase the amount of the well expense, the capital expense that could be immediately expensed instead of capitalized and depreciated, then yeah, you essentially lower the break-even price of gas and crude that's required to drill, and that would have an effect. Um, you could also, this is the one I really hope happens, is at least having some good guidance on what type of regulation we're going to have for long haul interstate pipelines, especially in natural gas. And we kind of touched on in Appalachia, but that's specifically the problem that Appalachia faces now, is that it probably would grow even at current prices because of outstanding well economics if it had confidence that it was going to be able to tap into an export market or the US Southeast.